Welcome to Ninja Blitz for financial accounting and reporting. And in this session, we will focus on IFRS. We begin with the International Accounting Standards Board, the IASB. The IASB issues International Financial Reporting Standards, or IFRS, and IFRS standards are the most authoritative in the hierarchy, and they are the first place that management looks for guidance on recognition and accounting policies. The IASB framework helps to develop standards but is not a standard itself and does not supersede any standards of authority. The objective of the IFRS framework is to provide users with information. Now, there are some assumptions that go along with using IFRS. First, the assumption is that the entity is a going concern. IFRS cannot be used if the entity is not a going concern. Second, the entity must use the accrual basis of accounting in order to use IFRS. Now, under IFRS, there are qualitative characteristics, and those are understandability, relevance, reliability, and comparability. Understandability means that it's easy to use. The information is easy to use. Relevance has predictive value, confirmatory role, and materiality. Relevance helps a user to make decisions. Reliability includes faithful representation, substance over form, neutrality, and prudence. Now, what is prudence? Prudence means exercising caution and completeness. Comparability. Now, comparable financial statements are required under IFRS. They are not required under US GAAP. So what are the constraints of IFRS? The constraints of IFRS are timeliness, cost versus benefit, and fair presentation of the company. Now, IFRS can be overridden if the financial statements misrepresent the true financial condition of the company, but if IFRS is overridden, it must be disclosed. Recognition for balance sheet and the income statement. Now, in order for recognition to take place, it must meet the criteria for an element. What is an element? An element is an asset, liability, equity, income, or expense. And also for recognition, there must be a probable future economic benefit, and it must be able to be measured reliably. Now, if it can't be measured reliably, the cost recovery method must be used under IFRS. So let's compare IFRS versus US GAAP. Under IFRS, going concern is an assumption. No extraordinary items are allowed, and you must use comparative financial statements. Also under IFRS, there is no completed contract, no LIFO, and and also a statement of comprehensive income must be included. There are also some other changes from IFRS to GAAP. Included is a statement of changes in equity, and also IFRS uses the term income versus revenue with GAAP. Under IFRS, gains are not separated from income, but losses are separated. And also, IFRS uses the phrase profit instead of net income. Let's move on to IFRS transitioning. Now, the date of transition is the first reporting period that an entity produces full comparative financial statements using IFRS. Now, if IFRS was implemented June 2010 for use in the December 31st, 2010 financial statements, then the date of transition is actually January 1st, 2009, because a full year of comparative statements is required from the previous year. Now, for IFRS transitioning, for property, plant, and equipment, the fair value election is the most efficient method for converting assets to IFRS. So on the exam, what is the most efficient method? It's the fair value election. Now with IFRS transitioning, adjustments made for adopting IFRS get made in the entity's retained earnings or equity. Now let's talk about current liabilities. You can refinance a current liability if the refinance agreement is executed before the balance sheet date. So IFRS requires that it's actually executed before the balance sheet date. GAAP, on the other hand, only requires intent, not execution. Now, a contingent liability is where, well, a contingency is an uncertain future event. Now, IFRS uses the terms probable and measurable for a contingency. GAAP uses probable, reasonably possible, and remote. Let's move on to bonds. Bonds may be recorded on the statement of financial position using one of two methods. Fair value through profit or loss, and that's where the liability is revalued at the end of each period and the gain or loss is recognized in the period. Or amortized cost using the effective interest method. Now, with deferred taxes, moving on to deferred taxes, with the liability method, IFRS uses the liability method, and all deferred tax liabilities must be reported. Only probable deferred tax assets can be reported. So all deferred tax liabilities must be reported, but only probable deferred tax assets can be reported. Now, deferred tax assets and liabilities are non-current on the statement of financial position. Deferred tax assets and liabilities can be netted only if they relate to the same country or taxing authority. So for instance, China deferred tax assets cannot offset Japan deferred tax liabilities. Now, tax rates for deferred taxes. IFRS uses the enacted tax rate or the substantially enacted tax rate. GAAP uses the enacted tax rate only. Financial reporting for IFRS. You have income. On the income statement, you have income, finance costs, tax expense, discontinued operations, and you have profit and loss, including profit and loss from a non-controlling interest and profit and loss that is attributable from equity. Now, the statement of comprehensive income uses two statements. GAAP allows three, but for IFRS, two statements are allowed. They are the income statement and the statement of comprehensive income. Fixed assets, starting with property, plant, and equipment valuation. Under IFRS, fixed assets are recorded at cost, and they are valued each period using one of two options. You have the cost model, where the asset is carried at cost, less accumulated depreciation and impairment loss. And then you have the revaluation model, which is where the asset is adjusted to fair value, less accumulated depreciation. Now, any increases in the current period go to other comprehensive income. If the adjustment is negative, then it goes in the current period to the income statement. Investment property is recorded at cost and revalued using either the fair value model or the cost model. With the fair value model, profit or loss is recorded in the current period in the income statement. With the cost model, it's carried at cost minus accumulated depreciation, but the fair value must still be disclosed in the notes to the financial statement. Moving on to leases. Operating leases can be recorded as investment property if measured at fair value. All other investment property must use the fair value if one asset uses it. And also, if substantial risk of ownership has passed to the lessee, then the lease must be accounted for as a finance lease. Intangible assets. Intangible assets are valued using one of two options, the cost model or the revaluation model. Now, with the revaluation model, the asset is adjusted to fair value, just like we discussed, less accumulated depreciation. Now, any increases in value from the adjustment are reported in other comprehensive income. Any decreases go to the income statement. What about internally generated goodwill? Not recognized. Now, intangible assets that have a finite life are amortized over its useful life. Intangible assets that have an indefinite life are not amortized. Instead, they are tested for impairment at the reporting date. Let's discuss pensions and defined benefit plans very briefly. And just know this for the exam. The project unit credit method calculates the present value of the defined benefit obligation. So just look for that word when you're talking about pensions. The project unit credit method calculates the present value of the defined benefit contribution. Finally, statement of cash flows. Interest expense or finance costs can be classified as either operating or financing under IFRS. But once a classification is chosen, all future costs must be classified there. And finally, significant non-cash transactions must be included in the notes to the financial statements. So let's review. Question number 1. What are the qualitative characteristics of accounting information within IFRS? They are understandability, relevance, reliability, and comparability. Question 2. What are the constraints within IFRS? They are timeliness, cost versus benefit, and fair presentation of the company. Question 3. What are some of the major differences between US GAAP and IFRS? And there's several, so we'll just go through them. No extraordinary items under IFRS. Comparative statements are required under IFRS, and they're not under US GAAP. IFRS does not allow completed contract. IFRS does not allow LIFO. Question 4. If IFRS was implemented June 2010 for the December 31st, 2010 financial statements, what is the date of transition? The answer is January 1st, 2009, because a full year of comparative statements is required from the previous year. Finally, question 5. When property, plant, and equipment is valued using the revaluation model, where is the adjustment for an increase or decrease recorded? If it's an increase, it goes to other comprehensive income. If it's a decrease, it goes to the financial statements, the income statement.